Absolutely. So my name is Yoko Okano. I'm the other half of First Row Partners. We'll talk a little bit about First Row and who we are and how we show up, as well as sort of our backgrounds a little bit more as we get going here. But today we wanted to talk about the sort of investor conversation guides and due diligence. Often there's a lot of focus on what do you do, what do you put into pitch deck? What's that kind of initial way you stand out? But as many of the founders here know, it's a process, right? It's a relationship building process. And so we wanted to highlight a few of the places that we see some of the difficulties show up. So that's what we'll be covering today. Minda, maybe you could talk a little bit about us at First Row, and then I'll talk about us in the next slide. You're muted still.
Wonderful. Okay, so Yoko and I invest as pre-seed specialists. We think that this is a really unique stage of company where there is a lot of ambiguity, and just having seen a lot of different things as operators helps us bring really good questions to you as a pre-seed company, whether that's during our first conversation or post-investment. And really where we get excited about technology is where it is an empowering tool for human expression. And we see that AI has the potential to kind of go either way, either try to mimic humans or support humans in their creative endeavors. And that's sort of the side we're on, and investing in that perspective. We also really find it interesting how we are now sort of buying and doing commerce through being entertained and using media. So those are just some of the areas we choose to invest in, but the business models end up looking like marketplaces, B2B SaaS, and vertical AI, or purpose-built AI. In other words, it has a specific function and isn't a broad sort of large language model itself. And so in Fund One, Yoko and I are women. We invest in a broad variety of people across that. It ends up being a reflection of our network, which we think is a really strong point, that it reflects demographically in a really broad way. And that's exciting for us. We think we can always be doing better. But if you just look a little bit at our sort of backgrounds, we came as sort of out of big tech, Yoko at Google, me at Accenture, working with legacy tech, seeing people on the front lines trying to adopt new technologies and in different waves of sort of the internet and internet 2.0, et cetera. And I think that one of the things that distinguishes us is that we like to explain things that we have learned. I think that reinforces it for us as people who like to follow frameworks. The more we talk about them, the more we can be effective at using them ourselves. So this is an opportunity for us to always be learning and sharpening. And that has led to us also spending time at the University of Washington, where we are teaching entrepreneurship and investing, often sort of flipping the content in both directions. And so we love opportunities to do that and to help people through experiential processes where they're navigating ambiguity. And so that's just really the heart of what we do and where we come from. And I think that it differentiates us because we just take a more inquiry-based approach to everything we do.
And actually, that's a good segue. Our first, we'll start actually with a question for you all, especially the founders in the room. We kind of have, I would say, 4 parts that we're going to cover. So one is just kind of to ground us a little bit in what is this round of funding? Where does it fit in the process? Talk about where those investor conversation, what are the questions they're asking? What are they looking for? How might that show up? And then what do we do in due diligence, and how can it prepare? So, we'll walk you through all those things. But for the founders here, maybe a couple of you could share, and then the rest of you folks, maybe you can add in the chat. Like, what are some of the biggest questions you have about a question an investor has asked you, like, why did they ask me this? Or like an area that they were really curious about that you weren't prepared for. So maybe a couple founders, if you could share, and then, if feel free to add in the chat if you prefer that. No questions about questions?
I think it's kind of hard to understand why we would even ask that, Yoko. I mean, when I was a founder and I met with one of the first investors, they asked me a really perplexing question, and it was, what kind of company are you really building? Are you going to be a food company, or are you going to be a software company? And I didn't understand why. I was confused by the question. I hadn't thought about that question before, and really didn't have a strong response to an answer. And now it seems so clear what they were asking and why. And I think that that's kind of where you and I are, pulling things out of our experiences. So that's just, I'll put that out there as one that
totally. And I also
confusing.
feel like this is also an unfair question sometimes, because I think as founders, you often feel like you have to have all the answers anyways, because that's, really what's being asked of you in that moment. And so, this is starting from a place of vulnerability. Elizabeth, thank you for that question around the milestones. And we'll talk a lot about this. Minda gets very excited about milestones, as you know. But just keep this in the back of your mind as we go through. And if there's things that come up for you as
Mitch
we're going through some
unmuted,
questions.
so you might ask Mitch if he wants to say something.
Sure. Mitch, do you have a question or an area?
Yeah, just a follow up on that question on, one of the questions we get asked is, again, what we're focusing on, and, how to simultaneously talk about all the opportunities we have and how we could flex in different directions and have a great, long-term roadmap, but also hit that here's exactly what we're focused on right now. And this is our first thing. And just how do you achieve the right balance of that in communication?
Yeah, that's a tough one. And I often am listening for, you will eventually build, maybe this is a bad analogy, I don't know anything about building ships, but you will eventually build the cruise ship that goes around the world. But today you have this like rickety raft, or maybe you just have like this piece of wood that you're floating on. Are you aware of the fact that you're on that raft? And are you aware of what needs to happen for you to be the captain of that larger ship? I think for me, that's often the way I ask founders to, paint the picture for me, connect those dots, because I need to understand self-awareness of where you are today, and then sort of the little miracles that need to happen for you to upgrade each way. That makes sense. And we'll dive into this more, but that's a great question.
And I think it's one that founders can prepare for, how to connect those two dots. But it is the first time you get it. If you haven't thought about it in advance, a lot of times the answer isn't as sharp as you wish it could be.
It's alarming. All right, so we'll kind of start with the sort of, just to make sure that we're all kind of understanding the way that Minda and I are talking about fundraising and sort of the process and strategy around it. So just a little kind of intro to fundraising. This might be repetitive to stuff you've seen other Seattle Angel Conference workshops, but sometimes the repetition is there for a reason.
Mm-hmm. So the way that we think of companies who decide to take this form of capital versus another form of capital or financing, which could be through customer revenue, or it could be through a CDFI loan, or it could be through a non-dilutive grant. But if you choose to get on the path where you are taking investment into your company in order to achieve a big leap in value, you're expected to continue to do that, sharpen up to the right, following that red line in as quick a time as possible to a cash exit. Yoko and I referred to this process of leaps in value in a very short, compressed time cycle using large amounts of capital as being the venture treadmill. When you step onto it, you think, great, I've just raised $500,000 from angels. But in fact, you are now sort of a frog leaping to the next lily pad and will continue to do so. And you always need enough capital to make it to the next lily pad without falling in the water, AKA running out of cash. And you also need enough sort of flex as a frog to be able to jump high and leap. So those are sort of the two elements that we focus on, but we do also want to communicate that not every business model is designed for leapfrogging, and not every founder wants to do that kind of business building exercise, but it is a treadmill. And it moves faster and faster at each leap in value. There are other ways than frogs and lily pads to describe this. I absolutely acknowledge this does not have to look like a cartoon, but that is simply a spring-loaded metaphor that Yoko and I have gotten to use. And actually, I think maybe it'll sort of help what we say make sense here, which is that as you are building confidence to this very last question on the slide, which is, can you get the confidence of the investor that they can believe and have reasons to do so, that you could be wildly successful, that you could build the cruise ship? And there are just sort of different elements that you're always trying to speak to and inform, and you have lots of different points of contact in order to do that. You're always presenting who you are and what you do in every context, not just when the spotlight is on you to do a, quote, pitch presentation, and then the camera somehow goes off and all of a sudden you're not in the process. You are always in the process. So there are a couple filtering questions that we would use to see if you are the kind of company that can make those leaps in value. And really they kind of come down to, can I expect a liquid exit of my investment of about 10x or more in 6 to 8 years? If I can imagine you following that profile, then that fits my model for financing. It doesn't necessarily mean anything about the quality of your company as being viable as an effort. But what I'm looking for is, are you spring-loaded today to take my capital? Or are you not yet spring-loaded with the signals of a team that can build and sell a product that is at a stage that can demonstrate value to an external audience, and that there are some signals coming back to you off of what you have built that shows external validation of some sort of value that indicates demand. So those are the things that we're looking for. And I think of these as, leading indicators of revenue. And if you have revenue because of these things, you're going to be even more convincing to me. But I'm looking for you to really make it 24 months to the next set of investors. So I also am looking for, do you know the market for capital? A liquid exit means getting cash wired back to me. So I want to be able to return cash to my investors who gave me cash and expect a return. And I need to be able to wire them money. And if you do not have it to my investors, and that's the piece that I kind of want to double click on. Minda mentioned this in a couple different ways. When you talk about wild success, right? We are investors. Our wild success happens when we have those liquid exits and we're able to return capital back to our investors, right? That's what we consider wild success. Now, you as a founder, there is the question of like, what does impact mean to you? And that's a totally separate topic, but it's something to keep in mind too, because again, you want to make sure that you're taking on the right investment or right capital for your company and for the strategy that works for you. So just again, another kind of pin there. Mm-hmm. And so, Minda, but why is it so hard to pitch investors? It's challenging to communicate. First of all, so what I like to give people this analogy, which is that I am the investor in the blindfold. You are walking me into an art gallery and showing me a picture on the wall that is really abstract and not yet formed, and it's something I've never seen before, and you're trying to describe it to me in a way that I can build a picture in my mind of what you are seeing. And that's a really tough process. And it tends to get clouded if you use jargon that I don't understand. And you think that that's clarifying, and it really doesn't do anything to help me envision the picture. And it might actually lead me in the wrong direction to picture something. And so a lot of times founders, when they respond about why they don't want to invest in you and they give you a reason, you're like, but I said the exact opposite. And that's exactly what can happen when founders struggle to communicate and investors struggle to listen. And that's the conversation that we're trying to illuminate today. And we hope both sides can be better prepared to both communicate and listen. So that is why it is hard to pitch investors. They do not know this new thing you're building. Innovation is hard to describe.
Yep. And yes, exactly, John. What the founder says is not always what we hear. But, part of it is, what are we listening for, right? I always think about it as like, if I am listening to a pitch and I have a map in front of me and I'm just trying to figure out like, where are we going here, right? I'm trying to figure out where the things that you're saying fit into my understanding of your business. And so we'll talk about sort of those building blocks a little bit next.
And I want to call out Elena's question really quick, because she's in a drug discovery company where there's going to be a lot of capital investment before revenue is ever produced. So what I would say is, to clarify, what Yoko and I are talking about is building the machine of the business. And this is an iterative process. What Elena is doing something that goes from research in the lab to development as a product to commercialization. And that is a different process with a different capital step. And she has to get to a certain point in the process before it even makes sense to start thinking about building a machine around what she's doing, because she doesn't know if she's going to pass through the pass-fail gates of her experiment in the science part of it. So she's doing two things at once, whereas a lot of us are really just inventing something that's a new business model innovation. So Elena, I would sort of answer your question differently than I would someone who's building something that they know they can build because it can exist. What an investor needs to see is eventually some innovation, whether it's a scientific one or a business model one, that at its core has a value prop that spins like an engine inside of a larger machine of pulleys and levers that are things like cost inputs and channel partnerships and price models and all these different kinds of elements of a business model that all have to work as moving parts around this machine of a value prop that earns money in order to take money in on one side, let's say it's customer revenue from last month, and turn it into triple the customer and turn it into triple the output on the other side. This cycle of a machine self-propelling is really what you want an investor to see as your future. This could be a cruise ship. This could be a crazy, a machine that is just sort of pumping and producing energy of some sort. But fundamentally, we need to see your business model as a widget that can take resources in one side and multiply them when they come out on the other side. So that magic of your business model needs to be what's seen. And the classic ways to describe your business model are to talk about the size of demand and the quality of demand and the accessibility you have to that through the go-to-market strategy. The team that you can actually build and operate this thing at the exact same time, and that your product or solution is compelling and will be able to be durable in value, that it will keep getting bigger and better and stronger over time. And because it solves a real problem and it continues to have defensibility, you're probably going to get asked a lot about moat. You're like, I don't have a moat when I'm, rowing manually in a little rowboat. I haven't built the cruise ship yet. But you need to know at what point what is your business strategy for defensibility, and how will you be accruing that?
Yep. And I think, John, you mentioned sort of Techstars really filters on team. And I think we'll talk a little bit about this, or how the team questions and how we're computing on the team. But it's really important as a founder to know that these, this isn't the exhaustive list, obviously, right? But these are like 4 components that are kind of important to know at the upfront. And I think what we're trying to understand is how these gears start to interlock and work together, and how they impact each other, right? And I think as a founder, and somebody who has maybe built, every line of code, you have built this thing from scratch, it's really easy to just talk about product all the time. And I have a product background, like I love talking about product as well, but that's only part of the machine, right? I think if you over index on telling me all about the really cool things your product can do, but you haven't convinced me on the market, or you haven't convinced me on how you're actually going to reach the market, those are the things that start to be little gaps in my understanding of how the machine works.
Mm-hmm. And I would say to Elena's question about, do we wait for revenue? I would say Yoko and I invest in companies that are pre-revenue, but have line of sight on it. And so we don't actually invest in the kinds of companies that are science and tech innovations where there's a large amount of capital required before you actually get to market. And so those are a different kind of investors, actually. They have a different portfolio model, in fact. So you won't necessarily find much overlap between the two. And I think that's what makes life sciences investing and deep tech investing really interesting, but it definitely is a different kind of model than what we do. This is really more about business model iteration and readiness rather than innovation-based companies, where the exit may always be to a big pharma company and to never get to the go-to-market model. So innovation companies have different trajectories. And what we're talking about is really the business model kind of company, where this is the work of building value, it's happening through the business model.
And so we touched a little bit on sort of the funding milestones. So Minda, maybe you could talk a little bit about sort of the machine and then the milestones, and how do those things connect?
Yeah. So when we think about milestones, we're not thinking about activities that you can complete. What we're thinking about is there are projects you complete so that the market can give you a response. And so it's validation, right? Validating through customers, validating through conversations. We don't want to hear necessarily about you building your next branding exercise as a milestone. We don't need to hear about a new website. We need to know why you're building a new website and what it does to change the value of your company. So there could very well be an answer to why you need to redo your website and brand, but it really needs to connect to the change in value of your company that unlocks the next funding round, right? So we're interested in the outcome of your activities rather than the activities themselves. John said it the other day when he was saying, we don't invest in the OpEx activity, we invest in CapEx value, increasing the value of your company. We want the underlying machine getting built. We're not as interested in the activities that propel you once it's built. Those are sort of the exercises of daily company life and company building, and they are not necessarily what changes the value of the company. Generating revenue is a way to increase the value of the company, but it in and of itself doesn't necessarily, you have to be building something underneath that's part of the bigger machine, and that's what we're investing in. So really making sure you're not talking about activities of company building. Every time you are sitting in the middle of this is the founder sitting in the middle of two things. And I've seen this said a couple of different ways. And this is the way I like to think of it, which is the founder is managing a zigzag of progression of their company. And when they unlock some capital, they have to do a bunch of company building. And along the way, they have to be able to then reach back over into the market for capital and hit the benchmarks that are for capital access in order to zigzag back to the other side and do more company building. If you are a founder listening only to the market for capital and only focused on those benchmarks, you won't be doing enough company building on the other side to actually build the enduring value, perhaps. So only listening to investors telling you what the market is for capital is really only a very small part of the story of what really you need to do in making trade-offs of changing the value of your company, because the changes in value that you might be investing in don't have a soon enough payoff to affect your ability to tap more capital. So it's always making these trade-offs between company building and meeting the market for capital, so that at the end of the day, your job as CEO is that you don't run out of money. And that means you either have enough custom revenue coming in or enough investment revenue coming in. You're always making those trade-offs. So when, Yoko, maybe you can explain our sort of framework for listening.
Yep, because, I think there's a lot,
so
part of it, totally. Well, part of it is we just kind of talked a lot about sort of the context of what we're listening for. And, for especially investors, newer investors, sometimes like, okay, like, how do I even keep track of all of that? And I think it's really important. This is actually a form that we use and a framework that we use for our Deals and Drinks event, which is essentially like a virtual, I kind of think about it as a book club, but we're listening to deals instead of talking about books. And it's really about putting anyone into that investor perspective. And as we're all listening to a pitch, we are first like thinking through some of the internal questions. These are the questions that I'm kind of thinking through on my own, and we'll talk about these in detail next. But these are some of the internal questions I have that they're not often the questions I'm asking out loud. Because if I say, "Are you a builder?" founders will always say, "Sure I am," right? Or, "Is this innovative?" Of course they'll say yes. So these are the questions that are useful for me to ask out loud, but these are my internal questions. And then on the right, this is really where I'm trying to categorize the things I'm hearing and what I'm kind of listening for, right? So first thing, the things that are good, it's like, what's been de-risked? What's been built? What have you validated? Sometimes that question around like, do you need to have revenue? Well, certainly revenue might be one signal of de-risking or validation from the market, but it's also tricky, right? If you've gotten services revenue, but you're building a platform, that's actually not de-risked, right? That's, yes, somebody has paid you money. Maybe it validates that the problem exists. It does not validate your solution. right? So, but I am listening for, okay, have they built something? Yeah, they have, what is the value that's created? Maybe they have a proprietary model or what have you.
And
so
I think,
those are
Yoko, it's also important that we try to capture these as observations rather than conclusions, because we are believing that we are wearing a blindfold and may not yet fully understand or have connected all the dots. And so this is our inquiry-based thinking coming through, which is we try and ask questions in order to make observations. And we really try and stick ourselves there and suspend judgment and conclusion as long as possible in order to maximize that in-between stage of all these contradictory pieces of observation coming together. We like to really hold that and think about it.
And it's really hard to hold judgment, especially sometimes as you have, let's say talking to a founder in the space deeply well. Existential risk, it's going to be very hard to not just really be opinionated about why this won't work, right? But it's really important to then think about existential risks and I think often like capturing in the next 24 months, what could potentially derail this company? Maybe it's a regulatory thing that might happen. Maybe it's customer demand. We've seen, especially more recently with like e-com companies, people are asking supply chain questions, right? And so what are the things that might impact their trajectory? And again, we're not looking out all the way into the future. We're really trying to contain it into like the next 1 or 2 sort of cycles that we might have a little more visibility into. A lot of times when I'm doing my deals and drinks notes, a lot of my stuff goes into the open questions because there's a lot we still don't know. So often the open questions are like, how might, the go-to-market channel for this work work in this case, but not in that case, right? So it's how to reframe some of your opinions in some ways as open questions, because it allows for a little bit more exploration. I also love flags and signals. I think it's often a good place to also jot down things that you don't need to think about again. Maybe it's, wow, the founder is super charismatic and like they got me really jazzed about the market and the problem they're solving. But like, I just need to like take a moment, like to actually come back down to earth and like think about if it's a real problem. So that's sometimes a flag. Or maybe it's that team just gelled super well. There were some seamless handoffs. They seem to be really understanding each of the roles and the perspectives and the responsibilities they have. Or maybe there was a little bit of weird tension between the CEO and the CTO when I asked about this particular area of differentiation. I just want to note that because I want to come back to it at some point, but I just want to get it out of my head. And then the last question is often something I think founders especially forget about too, where in my investment role, I have to take my notes and then I have to go, Minda, I talked to this super great company and they do blank. I have to now tell Minda what you do. And if I can't do that quickly and with like the right, depth, the right level of depth, then it starts to fall a little, like the game of telephones starts to fall a little flat, right? And so I think that's always, I actually often tell founders when we send this feedback back to them to start there, because that's also one, it's where all of the hopes and dreams of the people listening to you show up, but also it tells you where you might need a little bit more work. Anything that I missed, Minda, here?
No, but I do think that it is really important to stick the landing, is kind of on that exact point. Like as a founder, just being able to really make sure that as you exit a conversation with an investor, that they really have captured what it is that you do and can describe it to someone else. I think leaving them with that, if nothing else, is what allows you to continue the conversation.
So we'll go through just a few examples of kind of areas that we're listening for and the types of questions that we might ask. But we'll make sure that the full set of slides gets shared. Each of the next, I would say 5 or 6 slides has kind of the questions we ask and the questions we're actually asking in our mind, those internal questions. So founders, this is a good one to sort of use to kind of inform and prepare But just know that it's a lot of text and we're not going to go through all of it. So Minda, when we talk about team background and team construction, let's talk a little about the types of questions we ask and like what we're really listening for when we're asking about your team.
Yeah, I think I'll start with what I'm listening for when I ask about team background is I'm not looking to know where you were. I'm looking to know what your capabilities are. And I'm ultimately trying to find companies that can both build and sell, because I want to know that they've got those two things brought together to be able to make progress with my capital. If they can't build and sell, then I don't see how we're going to be de-risking on the team side. Like, it means you still need one half of the equation. And now I have to take the risk that you can get the other side going.
Yep. And build and sell, I think that kind of also tags into the second question about, or the second area of team construction. And I think, yes, we want to know like what the current cap table looks like, but what we're looking for is for the risks that this team has, or the gaps that this team has, are they aware of them? And will they be able to bring the right talent to join and superpower this team even more? We don't really expect that a team will be fully baked in all ways. We want to cover as much ground as possible, but there's always going to be gaps. And so, knowing that there are gaps, do I believe that people will want to work with you? One of a great example, I feel like that gives a lot of confidence from our portfolio recently is we did some reference calls about this founder or these two founders, and can they attract and build a talented team? And I remember, Minda, I think you reached out to some of their prior teammates, and
by email.
I think by email, and every one of them said, we need to actually get on a phone call because my enthusiasm won't come through via email enough, right? These are the types of signals that help to build that momentum around that team being a magnet for great talent, and that they will be able to build a great, well-constructed team around them. I just lost one of my.
And I think also when we get to kind of that team background, if you talk about having worked at a large company, that doesn't tell me you can work at a small company. So really being aware of your fit for this moment, I think is important. Big company experience, you need to tell us how that translates into this moment. And sometimes that can come by having been paired with other activities in your past. So be aware of what it says about you if you've worked at a large company, and what it doesn't say about you yet, that what you're capable of today.
Yep. And we'll skip a little bit on problem. And again, these are going to be sent to you as product and solution, because I feel like, again, product and solution, it helps you focus a little bit. But let's talk about market and specifically competitive advantage. I know you have some very strong opinions about that competition slide. And so when we start talking about the competitive landscape.
Yeah, I definitely think there are some things that are not true strategic competitive advantages. And that is product features, for example. I don't believe that you having better features today than your competitors, the ones that you've identified that exist, is any sort of real true differentiation, because features can just be built and copied. Likewise, being lower priced is not a competitive advantage in the long run. What I'm looking for are things that are structurally unfair advantages for you to be able to either hold customers captive. For example, you're now a big part of their forecasting workflow, that now they won't be able to do it without you. There's friction in being able to change away from you, or you're able to mass a data set that is extremely proprietary and has unfair advantages that you will now own. Those are the kinds of things that accrue and build as an advantage strategically. So I always like to avoid the sort of 4-quadrant slide or the sort of grid checkbox thing on features, because I don't feel like that truly answers my question of strategically how that machine gets to be durable and strong.
Yeah, and I think to that earlier question about telling the story of where you are today versus where you're going to be, one of the questions I often ask is, who are your competitors today and who are your competitors in the future, right? Because often that might be a little bit different based on where you're at today. You might be competitors based on feature set, but overall, maybe, over time, you're actually working towards a more broader use case, in which case you are competing in a very different set of competitors. So you kind of want to understand where your defensibility grows over time.
Mm-hmm. And I also think, I spoke with a company that was working on an innovation, and they felt that their competitive advantage was that they were better than what existed today. And I said, okay, how much better? And they said, well, a lot better. And I said, great. How do you know? And it truly was that they had not actually seen it in action being better yet. They're an input to a bigger process. So be aware of how much needs to be validated by someone external to you, not just your belief that you're better. That is an assumption. And I want to see it tested in the market or by a customer in some way, even if, are there data points you can show me?
Yep. The question about like the competitive advantage about being the people.
Yes, sure. If that means you have access to customers in an unfair way, then yeah, I can see that. But being smarter, or in some way being better prepared technically, that may or may not be what is going to give you the difference, but it needs to show up as a structural advantage in your business model. Like, how does it make your business model better? Does it allow you to do something faster? And does that thing being faster matter materially to the outcome of your final business? So there are a couple of different, there's like Porter's, like 4 forces model, there are 5 forces model, there's 7 powers, there's all sorts of different business strategy frameworks for describing those durable advantages and competitive sort of defensibilities. And I would encourage you to really understand what they are, to know if what that is about your team directly leads to you having one of those advantages. And if it does, the advantage is what you talk about. And then you relate it back to the talent on the team. But just saying that the team is talented in and of itself has to matter in some way. And that's, I think, how I would try and answer it.
No, where did my slide go? Okay, there it goes. All right. Also, some questions about business model, but we talked a little bit about this fundraising question, the current raise. I think the 2 pieces we talked about sort of, do you understand the market for capital? I think that's, we won't spend a ton of time there. The one I want to also highlight, when we're asking about your raise too, we're also listening for, will I have to act fast? Do I have to make this decision, or do I have a little bit of time? And so, this is just one thing to keep in mind. This is about building that momentum. We'll talk a little about that too. And I'm going to pause before we talk about due diligence, sort of how to prepare. Any other questions about sort of the questions we're asking, what we're listening for, what we're really trying to understand?
Because it is a subjective process for us to ask and answer the most relevant questions. We're always trying to do a good job of it, but I think it is, hopefully we've tried to illustrate how hard it is for us and how much we understand it's hard for founders, and that, to some degree we've been on both sides.
So a lot of time people are thinking that they need money because they need to accomplish tasks.
Yeah.
And the consequence of that is that they probably haven't done their core work on some part of their business, right? And so what do you recommend to people who are enthusiastic and jump into for me to get bigger, I need money, and then they approach the different groups without having done their homework?
Yep. And I would say the homework that they can do is answer that question of, how am I spring-loaded to change the value of my company through these activities? And you want to fund activities, so do I, but they have to change the value of your company. That's the story an investor needs to hear. So we don't fund, just keeping the lights on and selling and doing the same thing, that kind of, even if it means linear growth. we fund changing the value of your company. And so your need for cash to operate is not an investable reason for us to come in, because our capital has to be building the machine of your business while it's operated. It's not to operate the machine as it is today.
Yeah, I mean, I think Minda, you said it. For me, it's that linear growth. You know, with one of our portfolio companies, I've had conversations where I don't really care about linear growth right now, because in their case, you know, so for them, they were like, well, we need to, you know, it's like 1 or 2 new customers a month. I was like, okay, how about like we sort of know the inputs and outputs of that, right? But that's very linear growth. You know, we need to scale that growth more quickly. How do we do that? They said, well, we need to totally rebuild our onboarding process. So we need to do this thing that's self-service. Okay, let's do that, right? And so they actually, you know, they went from like really steady growth to, it was scary for them, but they had no new customers for a couple months. And then, you know, ideal what happens on the other side of that, then they turn on their self-service and you start to get, now we can take on 10, now we can take on 20. Right, that's when the scalable process starts to build in, and that's when you start to see that they are understanding the levers available to them to help them like leap to that next inflection point. Yes. Okay. So, what is due diligence about? And for the folks in Stack right now, you're in the middle of due diligence. And you know, the questions, I would say, like, you are getting deeper, one step deeper on some of the initial conversations and questions. These folks should deeply understand those investors should have a good sense of the market you're in and why it's important to be in. But it's really, you know, I think there's a few things to just kind of understand about the due diligence process. The timelines will differ. Right, Seattle Angel Conference is a specific timeline for doing it. They, you know, kicked off when they filtered for the finalists, and then they go through 4 weeks or so. Most firms have some sort of due diligence process. So just know that the timelines will vary, but the type of things that we're trying to understand are fairly similar and consistent.
And I think there are really sort of 2 things that are happening during diligence. One is the investor documenting their confidence through an investment memo, that they have that conviction that you have the potential to be wildly successful. The other thing is they're fact checking. And so those are sort of the 2 things that are going on, and you need to be able to support both of those. But, you know, kind of point number 2 is you should be doing diligence on your investor as well, by asking about their process and timeline, by asking for founder references, and by asking about, you know, agreement for, you know, which kind of terms and vehicle they have in mind, and making sure that there's sort of some common ground there that can be closed so that you can actually close a signature on a financing document and cash in the bank.
So and I think a lot of times during the diligence process, investors will be asking for information, some of these documents. So it's helpful to make sure that there's an organized place for this. Minda, you want to touch a little bit on NDAs?
Yes. In a case like Elena's company, where she's doing drug discovery, she's going to fall into probably a very different diligence process that looks more like point number 3, like a system by Donnelly Financial Services venue system that has an extensive amount of sort of staggered access to IP and science information, based on signatures of non-disclosure forms and a whole bunch of different very structured things that can be audited for access. On a software company where there's less sensitive IP information being shared, you're going to maybe use more of a Google Doc or a Google Drive. But NDAs are not going to be part of our process. And if you are asking an investor to sign an NDA on a company where you're building a new bicycle marketplace, you're going to get a lot of no's. And that is probably what you should expect. And actually, you lose investor confidence for even asking. And so on a company, you really understand that, you know, your idea is not something anyone should sign an NDA to hear, and that it is a ding against you, in fact, for even asking. So know the norms on non-disclosure agreements for the type of company that you're building, And don't be tripping yourself up by asking for an NDA to be signed by an investor, because we simply see too much in order to be able to do that. And we just can't take on any liability like that. So we just will pass on even hearing your idea if you want us to sign an NDA. That's a real easy no for us. But like I said, when there's a science and innovation company, I think that those are different circumstances.
And I think if you are using a folder process, I often, this is a place where your organization and your kind of the diligence of your own frameworks shows up, right? And that it can build confidence, and sometimes it can, start to like wear out the edges a little bit, where you're like,
Yoko, have you ever seen an error on somebody's Excel model?
A couple times, but it's, and sometimes it's sometimes it's okay. Sometimes it's like, that was a weird copy or whatever it is, but sometimes it can start to, it's those little, like Minda said earlier, it's those little data points of doubt that over time, there's so many of them, I start to connect them, and it turns into a no, right?
Because remember, the default position on investment is from an investor is always no, right? So and you build confidence in drips and lose it in buckets. So just being aware of that at each point in this process, you're still pitching. You're still building trust. Yeah, exactly like John's saying, building trust with the investor. They need to be able to trust you in order to have confidence in you. So
I would say,
sharing documents is a key opportunity for that. Yeah.
And I think I would say, like, potentially nitpicky in the weeds recommendation. I get these Google Drive folders that have folders in them, and rather than having them shared alphabetically or just named alphabetic and sorted alphabetically, you could number them in order, right? Because it just helps me understand that you understand which groupings of documents are important for me to see. Because sometimes it helps with the organization. So that's just, I would say, like, very in the weeds recommendation that I would have. Mm-hmm. And then, Minda, how does information travel between investors? We don't talk to each other ever, right?
We do. We share a lot. And so, in good faith and with good intentions. So just be aware that information does circulate about what valuation you are expecting. And if you say that you're in due diligence with a particular investor, and then I talk to that investor because I know them, and they say, yeah, we've had one meeting, then that information, it just completely erodes trust when I hear something different. So being accurate and not exaggerating anything is really important. And we do talk and we do share valid amounts of information with each other. Expect that and use that to your advantage. Assume that people talk to each other and hope that you're doing all the things that support a really good conversation going on about you in the background. But having a valuation out there in a slide deck, that gets around. So don't put your valuation expectations in your slide decks, because you may want to change those expectations and reset. So old documents circulate too.
Yep. And so just a list of that, we're happy to share that might be helpful as you start to think about things. And I would say, like, if you don't have it, it's no big deal, right? It's you don't have it yet, right? So and also you don't necessarily need to have, you don't need to build something where there isn't anything. If you just started your company last week, you're like, I don't have board meeting minutes. Like, let's not go overboard on this, right? I think it's really as it becomes
incorporated. And to do Correct. So, you will have had your initial board meeting to do bylaws and pass bylaws, nominate investors, et cetera. So we do expect to see you be fully incorporated and to have those documents available to us. We don't want you to come to us ready for investment and still be an LLC that plans to convert. We need to actually see the conversion, and we need to see the cap table as it is in the corporate structure. And we need to see the vesting schedule, and we need to see that all those documents have been executed. So that is like the bare minimum. But yes, some of these things, if you don't have them yet, can be created, like a financial and unit economics model, but expect that these are the kinds of supporting documents.
And I was going to say some of the things on extra credit, they can sometimes also be good ways to keep the momentum building, right? So, it's like, hey, we're a little early for you, but I actually just added a new industry report because there was this really interesting thing that came out in the past week about the space we're in. Take a look at it. That's like, again, it builds confidence that you are really understanding and owning and driving the process. Mitch, we're going to get to your question about the sort of what to send on that first reach out in near the end. So what to expect, we'll talk a little bit about the type of investors and the information sharing. We talked a little bit about Minda. What do I expect from a lead investor versus angels?
I expect a lead investor to typically be a VC that others will agree can set the price of the round, and that they're tagging you to the market. They are reading the market and they're signaling that they can fill that round with the biggest check in and can help fill it out with other investors in their network. And I would see that that is a signal that they're saying, we have confidence in this company and are willing to sort of put the biggest check in and also shepherd them to the next stage of investors. So I have to believe that as a follow-on investor. And I expect that the lead investor has done a full diligence and that I can sometimes rely on them. I may say sometimes talk to the lead investor and say, okay, you spoke to 3 of their customers. Tell me what you've heard. So that I don't need to have you repeat that with your customers, giving more people access, because I know I'm a follow-on investor. In other words, I will be in the round, but I am not setting the price, nor am I promising to fill the round, nor am I promising to be the person that gets you to the next stage. VCs in the lead position should really be setting the terms, not getting better terms, but they may ask for things like board seats and pro rata and information rights that you may not give to all investors unless they hit a certain threshold of investment. I think that's fair. But I am hearing a little bit of discussion out there about lead investors getting a much better deal than other investors, and then the founder sort of not being sort of supposed to disclose that. That creates a lot of friction. Look to avoid those. Board seats at pre-seed is unusual and should be avoided, because then when you get to later stages, the new investor expects to be your first board seat and the only investor that votes. And so you will be creating a problem. If you need to have them on at that level, have them as a board observer, where they don't have a fiduciary responsibility and they don't have any actual vote. So you have not involved them in governance. You have simply involved them in the cap table.
And John, you're right. Lead investors can be angels. Some of these sort of super angels that often are able to sometimes write larger checks, have a good network of both VCs and angels that might come in behind them and around them. The one thing I will say is often we look to who's leading as an indicator of the and their savviness and understanding of the capital market, right? Especially in the frothiness of last year, we saw a lot of really crazy valuations. And sometimes it was like, we have a lead, this person totally said they'd come in or let me come in with an uncapped safe. And it's like, I just have a bunch of angels who are my friends who are leading the round. And that to me is a little bit of a negative signal, because it is, especially today, it is not indicative of the state of the capital market. And with information sharing, again, as Minda said, be consistent. It's really hard when things go awry during your momentum building with investors, but anything that's inconvenient, anything that's negative, and anything that could be perceived as negative, be upfront with it. I also think for founders, this is a good checkpoint, right? Like for you, as you're working with somebody, if you're struggling to find ways and you're scared to tell them bad news today, imagine when you're telling them bad news when they're part of your company, right? And so I think it is a good gut check as you're going through the process.
And to Badri's question about a strategic investor, when I hear strategic investor, usually that means, for example, Boeing investing in my material science company because they think it's going to be a big part of their aerospace manufacturing. So therefore, it's a strategic investment for them. Strategic investor, where it's just sort of an experienced person in the industry and they're just sort of an elevated presence of knowledge or, somebody who's special. I don't consider that a strategic investor. So just sort of a definition thing. And so that is, not the same thing. And also just if they're putting in a small check, that's really not sort of leading the round in terms of setting the price for everyone else. It's just sort of, they're an early commitment and they're maybe it represents an endorsement by someone important.
Yep.
Which is good, but different.
So now that we've thrown a lot at you, how can I prepare? We'll just do a couple quick slides here, and then we'll kind of go and open up for Q&A. So, Minda alluded to this earlier. You want to make every interaction count. You're sort of always on at networking events. It's very hard, I have to say, being a part of First Row. So our branding is First Row. So every time I show up, John Seacrest makes sure I sit in the front row or the first row of an event, right? Like that's part of it, right? He's kind of holding us to our own branding and sort of professional presence as well. So similarly, think about those things around like what are, individually, how are you showing up? It can be a little bit confidence eroding when you have a 3 or 4 person team. And I meet somebody and they say, oh, I just do marketing, so I know nothing about the technology. Right. Like, again, that's an individual voice who starts to erode sort of the whole picture. Right. So just know kind of the consistency of the team, especially in these small teams, you do have the opportunity to really make your team stand out.
And if you say I have a CTO and I look on LinkedIn and they're still at Amazon and say nothing about your company, then I assume that person is not yet your CTO. And so now I have a sort of question and gap to fill there. So understand that your deck needs to match LinkedIn.
Let's see. If you're always on, team dynamics do show through. And I think this last point around meetings, using the time well is really important. I think, on one hand, as investors, we should not be burdening founders with the amount of time we ask for, right? But on the other hand, for founders, I do think thinking about like, okay, we have 45 minutes, let's say, how are we going to use the time well? Minda and I often set up during our process, we'll actually set up a call with the team and we say 45 minutes and we're going to talk about these 2 areas. I'm sure we'll talk about a lot of other things amongst that, but I'm really trying to understand these 2 points. So really trying to build some good structure into the conversations and trying to keep, again, things moving forward. Progressing forward is a really important thing.
Mm-hmm. And I think also just in terms of async communication, just be aware of, calendar and email diplomacy. It's really like when you're reaching out, maybe you're kind of thinking like, hey, I'll meet with you anytime. You tell me the time. But it's actually more helpful if you name 2 or 3 times and I can just say yes to one and not have to go back and forth. Or if you suggest using your calendar, but also say, there's this whole sort of calendar power dynamic thing, but like share your calendar, but say, but also let me know if you have another way you'd prefer to schedule a meeting, right? So understand when to show a little bit of deference on scheduling, and then the follow-up cadence of following up and doing what you said you would do in terms of sending documents, doing it in a timely manner, and also just those monthly updates always coming out. Remind us again what you do and who you are. Keep tracking the same metrics or tell us why you switched. So the quality of your monthly updates tells us a lot about you as well, if we are getting to know each other.
All right, since I know folks we're getting near time. All right, a couple of things. One thing I would say, yes, the one thing I really want to highlight here, make a root FAQ, use the question and the questions behind the questions that we will share after this as a starting point to build the FAQ of all the questions you hope an investor will never ask you because they're like the weakest part of your business and you're like, oh gosh, and nobody will ever ask them to in that way, hopefully. And if they do, they probably aren't a fit for your company. That's an aside. But I would say like just sometimes having them out on paper also allows you to be proactive about building the narrative for yourself. You're not responding from a defensive place, right? So build your FAQ, be prepared for all the questions. I think that's the biggest point that I have here. Minda, do you have any of these other points that you want to
I think it's
highlight?
really important to research the investor background and make sure you're talking to someone for whom they can and would say yes to your investment if all goes well. And that means that their no will actually be informative. So if it's an investor who would never have invested in your company at any for whatever sort of thesis reason, check size, et cetera, then the no that they give you is a no that you would have gotten no matter what. So it'll help you interpret feedback from investors a lot better if you know more about them and if you know what their background is and what they do and don't already know quite well. So you don't explain something to them that they would expect you to know that they deeply understand.
Yeah. And so, and that kind of initial sort of profile and understanding you have of them, you're sort of building on that as you go through the process and the diligence process as well. Are they kind of meeting your expectations around using your time well, asking, questions that really matter and that are relevant to your business? So, and what are other founders saying about them? I think that's again, you're entering into a very long-term relationship with this person across the table. And so you do want to really understand, not in just the evaluation mode, but do you think you might work together well? That's it. We got through it all. Let's talk about any of the questions that you have.
I love
your
people pop so
slides,
many
and then if you lower the slides, we can see people's faces.
Good call. I will do that because we don't need to look at the slides that says questions.
And then I'll take the spotlights off, and now everybody looks like they're there. Tricia has her hand up.
Yeah, I'm super curious. When it comes to the business and the financial models, especially for early stage companies, like how to right size the expectation of what to see in diligence. Like, are you giving scrutiny to the discount rate and like really digging into their WACC, or are you expecting PV from early stage companies? Totally unreasonable.
I love that question. It's so good because you know what the answer is that is like, it is fantastical thinking. And it's really cool if you can make up a spreadsheet and put in numbers and like make it look great. But I know that that's almost irrelevant. It just shows me you can build a spreadsheet with numbers. It doesn't actually forecast anything that's going to happen. It never goes that way. So I want to make sure you know that and didn't overinvest in that time. I'm far more interested in you understanding which levers are the changeable assumptions of what you can make. In other words, you know what you control, and that you're indicating the different sort of assumptions that you're currently making, that you're playing out the both sort of revenue and cash implications of running that strategy. So in other words, if you think, it's like, I want to know that you think you can get 100 customers in 3 months by doing X, Y, and Z, right? And then you can show them the spreadsheet that sort of shows me you doing that. But, it really is more important to me to see your thinking revealed through there and how you are running scenarios through a model that shows that it has the outcome that you intended from a revenue and cash perspective. So in other words, I also want to make sure you're making good operational decisions and not going to run out of money by accident.
And it can sometimes
happen,
reveal,
like revenue doesn't come in right away,
to
cash. So I want to know that you've synced everything up too. So those are the things I'm looking for more than what the 5-year projection is.
Exactly. It often also reveals some of the gaps. Like I remember a few years back looking at this projection, and it was a hardware company, and these folks came from hardware manufacturing. So their hardware estimates and forecasts, deeply researched, deeply probably fairly accurate. And then, but I saw a gap because they said marketing, $100. It was something like, it was like $50 or something like really preposterous. I'm not a marketer, but I was like, that just seems like a weird line. So again, it's one of those things where I'm like, it almost would be more helpful to leave it out. Or if you're going to put it in, put a flag around this is an assumption that we have not validated. And we know it actually should be probably closer to, this range or whatever it is, right? That is a much more satisfying experience than going, gosh, everything else looks good. But what is this? And I get really distracted by that, right? So see, John, do you have a question or?
Yeah, I want to follow in on that thought because I want to be more explicit than you guys are being explicit. So when we're looking at the financial model, I really appreciate when there's a separate tab, which is these are our assumptions. And not only that, these are our assumptions. And the red ones are the ones we pulled out of an orifice. And the yellow ones are the ones that we looked at an MBA report somewhere. And the green ones are the ones we've measured in some way. And that, when you do it in that kind of pedantic way, you now are giving us an understanding of where you're doing your work and where we should press, as opposed to the MBA hand wave, like, keep thinking with the numbers until it looks like the curve that I want, which I cannot justify with my execution whatsoever, which we then see as a fundamental erosion of trust, right? We can't believe you because your goal is to project where you're going and then to do better than that. And if we don't believe that the projection is right, then there's absolutely no way we can believe that your execution will ever work. Right.
And John, I think you're totally right. And I want to say, maybe Kathleen Baxley has her templates that she works with founders. And one of the things I love about that is it also helps you track what has already happened. Right. And so often, especially in Seattle Angel Conference, since you are doing diligence and you're sort of meeting these companies across a couple of months. And so what was true on, in September may not be true today. You have, and if you said that we thought in October we'd have 10 customers and you had 5, that financial forecast should look different. You should start having your actuals kind of feed in, and vice versa, right? Even if it's like, oh, we actually thought we had 10, we had 25. Cool, awesome, like that's great. But you want to start to see how that's going to now inform your trajectory and your sort of your assumption validation.
Yeah, I always realize too that some investors, they don't hear the narrative in order to build the picture, but they really hear through your spreadsheet numbers. It is incredible how much some people just really can see a business through seeing numbers and projections and assumptions. So help tell that story by calling out, like John's saying, call out your own thinking and where there is an assumption that has been validated, one that's been sort of, gathered, and one that is just sort of hey, we hope and wish that this is what it is. So that is a way that you can build confidence, because we know you don't have any answers, and gosh, we hope you're self-aware of that.
Elaine?
Great. Minda, Yoko, thank you guys. You met my goal for today. So you reminded me of what I need to make sure I emphasize in the due diligence report for tomorrow. And it was echoing that all teams at this stage, and it's great to repeat it for everybody here on the call, are probably not fully baked, not complete. And the question is not necessarily the fact that you are not complete, but it is, do you have that magnetism to complete it with great talent? And I loved the part, Minda, that you said about the product versus sales, right? Because here in Seattle, I think we see a lot of tech-heavy founders, and making sure that not only do you have a rocking product, but you can get it into people's hands who will buy it, and you make money from it, is a really good thing. So thank you for kind of, making that team piece super evident, because I don't want people to walk away thinking that the fact that their team is not fully baked at this stage is a ding, because it's not. That's what we expect. But how you fill it and will you be able to fill it is what is super important.
Yeah. I think it's great to reinforce that. Thank you. And then in terms of that blurb, Mitch, email a blurb, make it a clean forwardable that someone can send. First of all, be kind, be helpful to your person connecting you, and make sure that you do things like when you reference yourself, put your own LinkedIn link. Please don't make me go copy paste yet another thing, please. Oh my gosh. Make your deck accessible, those kinds of things. Just make it easy. And, don't bury the lead. Don't don't write an essay about, don't you wish that there was a lawnmower that could, no. Be really succinct. Say, our lawnmower saves 30% of so-and-so's time as a landscaper, and we finance that possibility for lawn care companies across the country. Our revenue is already this, our unit costs are, our margin is this. Just really tell me your business and what's been proven. You don't need to write some sort of promotional essay. That's distracting, and make it so that I want to open your deck and I'm curious.
Yeah. And she wants to open your deck. So hopefully the deck link is in the email as well. I would say, I often, it's like,
don't say,
cool,
if you're interested, I'll send you the deck. No, just like, please, let's just do this.
Shorten it a little bit. I would say there's two pieces that I would think about with the full deck versus we have, even for our fund, our processes, we often have a shorter deck that's kind of the highlights, and then a slightly longer deck that might include all the extra things about, like, that might include some of the appendix slides around, like, oh, you want to know more about our process, like, you want to know more about our, what the product looks like, here's a link to a demo, right? So I think those, I would try to have kind of a shorter version that's like 5 or 6 slides, and then maybe potentially a longer one that might include like the fuller set of slides, when you have a better sense of, like, oh, this person, when you talk to Yoko, she went deep on product and product roadmap, and it's like, I'll make sure to send the full version that includes that, and then call it out. It's like, hey, great to talk to you, here's a full version. The roadmap that we discussed during the call is in the appendix. That's, like, again, reminding, reiterating, kind of like pushing us forward.
But, like, really the purpose of the deck is to get the meeting, right? And then the purpose of the meeting is to get the conversation going. The purpose of the conversation is to get into due diligence, to get to the checks. So know just that you're trying to get to the next step. You're not trying to get investment because you wrote a great blurb and included a deck. And so in thinking about your call to action, and does this asset of the deck get you there? That's what it needs to do. I think doc sends are great, because then you get to see who spends time on which slide, if somebody actually viewed it before they met with you, all those fun things. But boy, I also love just really having a file, because then I can share it with Yoko more easily, and it doesn't expire, and I can do all sorts of things with it that way. It's just so much easier. But yeah, I totally understand the doc send thing. Just don't make me have to do a password. Like, that's annoying. That would be annoying.
And the doxin is also really nice, because when I'm now, maybe you sent me a deck like in September, and we said, oh, you know what, it's probably not a fit. It's a little early. And then now we're talking November, and I'm like, actually, I really want to share this opportunity with my this other fund. It's nice to have the doxin, because then I'm like, here's the link, versus being like, I have a PDF that says August. Is that the one I should send? And you're like, wait, which version do I have? Right? Like, so version control is a little easier when you have just one link that you're sharing out. John.
Yeah. So I'm getting myself distracted. In terms of the document sharing and so forth, I have the unfortunate habit of collecting all of the emails from all of the broken addresses on our domains. So I get lots of email from Minda and Yoko because people misspelled their names or whatever. And so I get to see thousands, literally tens to 20 a day, of people trying to talk to Yoko and Minda and all of our 700 alumni, almost none of which have even looked at our website. And so had they looked at our website and saw the structure of our program, they could have sent us a little blurb that would have fit into the thing, where the probability of us engaging just went from like minus 10% to like maybe 50%. But we keep saying do due diligence on the investors. So if we're going to do what Robert was talking about doing a cold email into a entity, then do the due diligence on that. And then Yoko and Minda, how do I find out what kind of things they will invest in? Where do I go? Going to their LinkedIn is not sufficient. Actually, going to their website is not sufficient usually, because they're not articulating clearly their investment thesis. So what should founders do to know what the right email to send to the cold email is, or better yet, what's the right thing that a founder should do that would send a warm introduction to them.
Right. So I'll use us as an example. Like, I think our website copy is pretty out of date, but our portfolio listing is not. And we have a tab on our website that says contact us, and it explains how to pitch us. So it's really easy for you to, contact us in a way that we're expecting. There's also a reference bookshelf on there so you can see what we're reading. So I think that tells you something about who we are. And then if you go to our LinkedIn, you'll see if we have any connections in common with you. And you'll also see a little bit more about us and the places that we're involved. And that might give you ideas about how you might think about what, that I think that rounds out context too. You can look at what we've posted on LinkedIn, where we're at, what we've sort of said in comments. Like, you can, like LinkedIn stalk us a little, and I think you'd probably learn a lot, but it would take a few minutes, right? But I think that there are some decent pieces that you can get by putting those things
on Twitter as well. So it's, thinking about like, what are the types of conversations she's been a part of? If there's a video, like this video is on YouTube, like how do we describe ourselves? How do we describe the type of founders that we like to
You can subscribe to our newsletter every month-ish. We are putting one out. And it tells you what we're thinking about our thesis and what has been going on, where we've been at. Like, you should really, it tells us how to, tells you how to pitch us. It we do open workshops. So I think we're pretty wildly accessible, but it does take maybe a few clicks and buttons to get to know us.
It is harder for individual angels. Some angels, keep their angel list fairly updated. Some folks don't. Some folks listed on their LinkedIn. Some folks don't. So sometimes also, especially in this early stage, it's about talking to founders in your space, in your stage, in your community, and finding out who the most active folks are, and then kind of potentially getting interest through them.
And John's favorite trick is the LinkedIn QR code. So use it. It's smart. And here is the trick that I think goes along really well with it. When you're at an event and you meet, let's say you meet someone like Minda, me, or John, or whomever, and you are like, great, I'm going to connect with them on LinkedIn. We're like, yeah, sure. And when you do that, say, it was so nice meeting you at the such and such event this fall. I'm glad we got to talk about how you think about the rail industry, like whatever. Then when I see you in my LinkedIn, I remember how we met. And that helps both of us.
That was such a great tip. Hey, I have kind of a specific question. So if anyone had more general questions.
No, go for it.
Okay. All right. I had a founder who's engaging with a VC, and she said, this VC asked me for a balance sheet, and I don't have any revenue. And I have been thinking about it, why I thought maybe it's just sort of a standard request for data, and it's not necessarily applicable particularly to this founder.
But I think a balance sheet does help them if you have debt. So if you have issued convertible note, if you've issued other convertible notes or safes, they would show up as liabilities. If you've made a loan into the company, it would show up under liabilities. So I might want to see a pro forma P&L, but I do want to see your balance sheet. I do need to know how much cash on hand you have. Are you solvent? And is the investment that I'm putting in going to go to be repaying debts? Absolutely.
Or is my investment going to go into an organization that has no financial discipline and doesn't manage its finances at all? And therefore, this is a really drop in a black hole instead of someone who actually knows where they're at with their finances. Sorry.
You feel strongly about that.
I do.
I can tell. Yes,
but I think, I think it's
it can be very simple, right?
It's a very simple thing, but I think you think about, well, why are they asking for that? And I would say, well, they're probably not looking for assets, but they're definitely looking for liabilities. And what is the, question of the company? How much are they actually, when you net it all out, are they solvent?
And let me reiterate that maybe they're not looking for either. They're just looking for process and discipline, and that you've organized your life in a way that's going to succeed rather than you're just throwing things in a bucket and hoping it floats out. So it may be, that the greatest risk to the organization is execution discipline.
Thank you.
Other questions, by the way? No?
All right. And then
So how many people here are currently thinking that they want to take pre-seed money from someone? Can you raise your hands? Use the little reaction thing so we can see you better. Yeah, so a handful of people are saying yes, they're taking outside money as a pre-seed investment. Keep your hands up, and if you have thought out what your valuation change will be because of that investment. Yeah, everybody's thought that out. All right, well, that's good because that's not my normal experience. Let me clear that. Should be able to.
It's like a live poll.
Yeah. So how many people here are thinking that they'll start angel investing and want to find pathways to starting angel investing? 2. All right. So we like to say that the angel conference is one of those starting points. We aim to be the first investment into companies, but we also aim to be the first investment by angels. But we will run a workshop in February, which is a Meet the Funders workshop, where we'll gather on the order of a dozen groups that are doing pre-seed funding in the Seattle area and go through what that looks like. And we can ask that question, what's the best way for me to start angel investing with your group? Just had a call yesterday with the Alliance of Angels on that very issue. So please look at the meetup group for that event as I get that scheduled.
I think Yoko and I, just to be clear, Yoko and I benefited tremendously from the education that we got through Seattle Angel Conference. And we benefited in 2 ways. One is just like the process of investing and being diligent and intellectually honest about how you think about making the investment, and that you have your own real reasons and conviction, and that it's not just I like this person investment. So I think learning that discipline was something that we really valued. And then learning, to think of to wonder along the way what kind of investor we wanted to be, and that was an individual decision. And I think then the other thing we also learned is the power of leadership in investing. And I think whether that was being the fund organizer, or whether it was, being a venture capital fund in the ecosystem, and then leading in sort of continuing to foster others, participating both on the founder-funder side. I think those things all came out of us really having gotten started in a lot of this through Seattle Angel Conference. So we send a lot of people this way.
Thank you. I appreciate that.
Education by having made some big mistakes. I'd rather see them start with
the classic answer is that I leave Microsoft. I have a friend that asks me to invest in their company. They're a friend, so I invest. I do that once or twice. They go build a great big hole in the ground. I blow up the investment. I blow up the relationship. And then I say, oh, angel investing sucks and I'm done. And we want to stop that. Many small checks that you can afford to lose is the right answer. Elaine, you have your hand up.
Yeah, I just wanted to put in a double +1 for the Meet the Founders event in February for all the Meet the Funders, for all the founders here on the call, because it is a hugely unique opportunity to meet so many organizations, both angel and VC, virtually, where you will, and Minda and Yoko, you can tell me how many other places can startup founders meet the caliber and the breadth of the funding sources at one place at one time in such an open forum.
Yeah, I think it's pretty unusual, right? And so it just is a great kind of concentrated moment to get that survey of who can I talk to about how do I find the angels in this community?
And of course, I think it's either during that session or it'll be at the finals. Elaine, you always do that great sort of visualization of where do we all show up within the ecosystem, right?
Yeah.
We're not all writing checks at the same time or taking the same type of risk. And so I think, from an ecosystem perspective, really understanding who should I be talking to first? Who should I not be pitching first, right? Is kind of a really important.
Like you're a pre-seed company. Keiretsu is far later in the stage of investments.
Exactly. So back to, kind of what Minda's point was, is make sure that who you are pitching to, and that they, again, remember, if you get them to fund your company, it's a 7 to 10 year partnership, very similar to a marriage. So you want to make sure going into it, you know about the partners that you'll be going on this journey with. And in this case, in Meet the Funders, you get to see and hear from, 10 plus at one time, and understand who might be right for your company. So an awesome experience. I definitely mark it on the calendar, no matter if you're coming from Toronto or LA. It's a great event.
Well, thank you. And one of the answers to your question about where you can find them is at the ACA meetings, but it's generally not an open conversation like it is in the funders thing. I also do want to mention that we have a event next week where we'll talk about how to be a venture capitalist using donor advised funds. So for people who don't yet have the accredited status and would like to build muscles, there's a mechanism for how to do that through a donation pathway that I think is a really good skill building process. And we will talk about that in detail next week on this time slot.
And that's something I want to know about, John. I have things to learn on that. More money goes into donor advised funds every year than comes back out into the ecosystem. And there are opportunities for venture investing through them that I think people are unaware of. So I know I don't know enough. I think we should all be learning more.
The core thing that most people don't understand is to be accredited as an individual, you have to be a millionaire or have adequate income, 200K or 300K, depending on the path. But entities are accredited when they have 5 million in assets. And so small businesses that have 5 million in assets, or big businesses that have 5 million in assets, or nonprofits that have 500 million in assets, all can be accredited. And so foundations that let you do donor advised funds suddenly make you accredited with your fund. And we can walk through that in detail next week on Thursday. And in a marketing point of view for the people that are doing funds, when you're talking to, and I'll use a derogatory term here, when you're talking to soccer moms and you're talking to them about the mission from God that you're trying to solve, often it's easier to get the 25K donation than the 25K investment. And so you have two tools to work with instead of just the one. Nonetheless, more on the details of that next week. If you have topics that you wish we would talk about, please feel free to contact and give us a hint, and we'll start doing those. Minda and Yoko, it's always great to have you working with us on this. I really appreciate your support. We'll look forward to engaging more on this in the future, especially the Meet the Funders in February. We want you there. And everybody else, thanks so much for being here.
Thank you.